Namaste everyone. I, khushboo Jangid, working as an assistant professor in the Department of Commerce and Management at Jayoti Vidyapeeth Women's University, Jaipur. Today we are discussing the topic ratio analysis. Ratio analysis is divided into two parts: structural classification and functional classification. Functional classification is further divided into five parts. First is liquidity ratio, second is activity ratio, third is profitability ratios, fourth is capital structure or leverage ratios, and fifth is investment analysis ratio. Structural classification of ratios and liquidity ratio. These two we have already covered in the previous videos. In this video, we will talk about activity ratios. Activity ratios are again further divided into 8 parts. First is stock turnover ratio, second is debtor turnover ratio, third is creditor turnover ratio, fourth is total asset turnover ratio, fifth is fixed assets turnover ratio, sixth is current assets turnover ratio, seventh is working capital turnover ratio, and eighth is capital turnover ratio. Out of these 8 ratios, first two, stock turnover ratio and debtor turnover ratio, we have already covered in the previous video. Now in this video we are going to discuss the remaining ratios. First is creditor turnover ratio. Creditor turnover ratio basically determines the relationship between company's net credit purchase and average trade payables. To calculate credit turnover ratio, the formula is accounts payable turnover ratio or credit turnover ratio is equals to net credit purchases divided by average account payables. Now, to calculate the net credit purchases will be given in the question, or some other information will be given in the question related to net credit purchases. Now to calculate this denominator, average accounts payable, formula is given here. There are three formulas to calculate average accounts payable or average payables. The formula to calculate credit turnover ratio is net credit purchases or divided by average accounts payable. Now what is this average account payable? Average account payable is creditors and BP, creditors plus BP, and BP is bills payables. The net credit purchases will be already given in the question, or some information will be given in the question. Now to calculate average payment period, the average time in which we pay the payment is total or average payables divided by net credit purchase multiplied by number of months or days in a year, or months or days in a year divided by creditor turnover. Or the third method to calculate average payment period is total or average payables divided by net credit purchases per day. Now in this last one formula, net credit purchases is given as denominator. To calculate this net credit purchase, the formula is net credit purchases divided by 365. Now let's understand this ratio with the help of an example. One example is given. In this, the question says calculate the creditor turnover ratio from the following data. Credit purchases during the year is given as 12 lakh. Creditors plus bills payables in the beginning of the year is 4 lakh and at the end of the year is 2 lakh. To calculate creditor turnover ratio, we require two things: net credit purchase divided by average accounts payable. Net credit purchase is already given in the question, that is 12 lakh. So we will take this amount as it is. The next is average accounts payable. To calculate this average account payable, we just have to add these two amounts and divide it with 2. At the beginning and at the end, we have to add these two, 4 lakh plus 2 lakh, and then we have whatever answer will come, we have to divide it with 2. So the average account payable is 3 lakh. To calculate creditor turnover ratio, we just have to divide this 12 lakh divided by 3 lakh. The answer will come as 4 times. So this is the creditor turnover ratio. Next, we are going to talk about total asset turnover ratio. This ratio basically talks about the efficiency of the company's assets in generating revenue or sales. That means कंपनी की assets कितने efficiently revenue generate करती है कंपनी के लिए. This basically shows the relationship between cost of goods sold or net sales to the investments of the firm. The ratio to calculate total asset turnover ratio is net sales or cost of goods sold divided by total assets. Next, we are talking about fixed assets turnover ratio. In this ratio, this ratio measures company's ability to generate sales using fixed assets. As we have talked about total asset turnover ratio, this ratio, total asset turnover ratio में सारी assets include होती हैं, and in the fixed assets turnover ratio, only fixed assets are included. This ratio talks about the relationship between fixed assets, depreciation will be excluded, and net sales or cost of goods sold. The formula to calculate fixed assets turnover ratio is sales or cost of goods sold divided by fixed assets less depreciation. Next ratio is current assets turnover ratio. This ratio shows the relationship between current assets and net sales. The formula to calculate current assets turnover ratio is sales or cost of goods sold divided by current assets. Next formula is working capital turnover ratio. In this, instead of taking current assets, fixed assets, we are going to take working capital of the company. To calculate the formula of working capital turnover ratio, we just simply have to take sales or cost of goods sold, and then we have to divide it with net working capital of the company. Next ratio is capital turnover ratio. This ratio establishes the relationship between net sales or cost of goods sold to capital employed. The formula to calculate capital turnover ratio is sales or cost of goods sold divided by capital employed. Now, whatever formulas we have discussed, we are going to understand these all formulas with the help of an example now. One question is given here. The question says, the following is the balance sheet of Sanchit Company Limited as on 31st March 2006. The balance sheet says that This is the liability side, this is the amount, this is the asset side, and this is the again amount. The share capital of the company is of 80,000, general reserves are of 30,000, profit and loss account is of 50,000, mortgage loan at the rate of 10%. 10% is the interest rate, is of 80,000, creditors are of 40,000, bills payables are of 20,000. Now these were the liabilities of the company. Total of the liability side is 3 lakh. Now the asset side says fixed assets are of 1,60,000, debtors are of 60,000, bills receivables are of 20,000, cash at bank 50,000, preliminary expenses are of 10,000, and the total of asset sides also is of 3 lakh. Some other information is also given, and that is sales is for 1,60,000 and the profit is of 25%. Gross profit is of 25%. So this was the whole information that was given in the question. Now from these information we have to calculate these 5 ratios. First is capital turnover ratio, fixed assets turnover ratio, capital turnover ratio, current assets ratio, and total assets turnover ratio. The first is capital turnover ratio. The formula to calculate capital turnover ratio is cost of goods sold divided by capital employed. Cost of goods sold, how we will calculate? The sales is given here as 1,60,000 and the profit is 25%. We just have to calculate this 25% and then we have to subtract it from the sales, total sales. Sales here is of 1,60,000 and 25% of 1,60,000 gross profit we are calculating. So to calculate gross profit, we just have to take 25% of this 1,60,000. That will be amount. That amount will be 40,000. So we just have to subtract 1,60,000 minus 40,000. That will be our cost of goods sold. The amount will be 1,20,000. So cost of goods sold we have already calculated, that is 1,20,000. Now let's calculate capital employed. Capital employed is basically fixed assets plus current assets minus current liabilities. Fixed assets is given here, it is 1,60,000. Now we just have to add current assets in the question. The current assets are of 60,000, debtors 20,000 bill receivables and 50,000 cash amount. Now we have to subtract current liabilities. Current liabilities is given in the question, that is creditors and bills payable. 40,000 and 20,000, that amounts to 60,000. The capital employed is 2,30,000. Now the next ratio is fixed assets turnover ratio. The formula to calculate fixed assets turnover ratio is cost of goods sold divided by fixed assets. Cost of goods sold we have already calculated in the first part of the question. Fixed assets is already given in the question, that is 1,60,000. When we'll divide these two, we'll get our answer, and that is 0.75 times. The next ratio is working capital turnover ratio. To calculate the formula to calculate working capital turnover ratio is sales or cost of goods sold divided by net working capital. Cost of goods sold again we have already calculated in the first part. Next we have to first calculate net working capital. Working capital we can calculate just by subtracting current liabilities from current assets. Current assets are of 1,30,000 and current liabilities 60,000. These two we have already discussed here in the first part when we were calculating capital employed. These were the current assets, debtors, bills receivable and cash. And creditors and bills payable are current liabilities. So after calculating, we'll get working capital, that is 70,000. We just now have to divide 1,20,000 by 70,000. The answer will come 1.71 times. Next ratio is current assets turnover ratio. All these formulas are basically similar, just the denominators are different. If we are talking about current assets, the denominator will be current assets. If the ratio is total asset turnover, the denominator will be total assets. So the formula to calculate current asset turnover ratio is cost of goods sold and divided by current assets. Cost of goods sold, again as we have already calculated, it is 1,20,000 and current assets also 1,30,000. When we'll divide these two, we'll get the answer 0.92 times. Next and the last ratio is total asset turnover ratio. Again the formula is cost of goods sold divided by total assets. Cost of goods sold is 1,20,000 and total assets 2,90,000. Total assets includes fixed assets also and current assets also. The answer will come 0.41 times. So I hope you have understood these activities ratios properly. In our next video, we have covered liquidity ratio and activity ratio. In our next ratio, we will cover profitability ratios. Thank you.